When the Federal Reserve cuts interest rates, the headlines are everywhere. The Fed slashes rates, markets surge, borrowing costs drop. But here's the real question. What does it mean for you and your retirement plan? Because while Wall Street traders might celebrate, retirees and pre-retirees face a whole different set of challenges when rates move lower. So in today's video, I'm going to break down the 6 smart money moves that you may be able to make when the Federal Reserve cuts rates and how to think about it relative to your retirement plan, because the goal here is to keep your retirement plan on track no matter what the Federal Reserve does. I'm Jim Martin, the founder of Martin Wealth Solutions, where we help people just like you plan well and retire happy. And if you're in your 50s, 60s, or already retired, this video will give you clarity to help you navigate the financial ripple effects of falling interest rates. So let's start with the basics. When the Fed cuts rates, it lowers the cost of borrowing all across the economy. Mortgages get cheaper, business loans get cheaper, car loans, credit cards, they can get cheaper too. But on the flip side, savers usually suffer. CD rates, bond yields, and money market returns, well, they all tend to drop when rates get cut. So while younger folks, they might focus on borrowing, retirees have to think about what the rate cuts mean for their portfolio, for their income, and their long-term financial planning. All right, let's dive into those 6 smart money moves. Move number 1, I want you to revisit your fixed income strategy. First, take a hard look at your fixed income investments. When the Fed cuts rates, the yields on new CDs, Treasury, and bonds, well, they typically go down. That means if you're relying on CDs or a bond ladder for income, the reinvestment rates, well, they might be lower than what you previously locked in for. For example, maybe you bought a 2-year CD at 5% last year. When it matures, that new rate might only be 3%. Over time, that reduction in income, it can really add up. So what can you do? Lock in longer maturities now if rates are still relatively attractive to you. If you believe rates are headed lower, extending the maturity of some of your bonds or CDs or fixed annuities, they could preserve those higher yields. Consider diversifying beyond plain fixed income. Consider municipal bonds, preferreds, or even certain types of annuities that might provide you a fixed rate. And make sure your bond allocation is designed for stability first and yield second. Chasing higher yields in a falling rate environment often means you're taking more risk than you actually realize. The key is balance, protecting income today while keeping flexibility for tomorrow. Let's move to move number 2. Consider debt and refinancing opportunities. A smart move here is to look at your debt. For retirees, debt can sound like a 4-letter word. I get that. But not all debt is necessarily bad. And when the Fed cuts rates, generally speaking, borrowing costs can go down. This opens up significant opportunities. Think about mortgages. If you have a mortgage, can you refinance that into a lower rate? Look, even refinancing by 1% might be able to save you thousands of dollars on the life of the loan. And it can make a huge difference around cash flow. Home equity lines. If you've been considering a HELOC for a home improvement project, a lower rate environment might make borrowing even more affordable. Paying off variable debt. On the flip side, if you carry credit card balances or variable rate loans, use the rate cuts as motivation to get rid of those while the cost is temporarily lower. The goal isn't to take on unnecessary debt. It's to optimize what you already have and potentially free up some additional cash flow in retirement. That always sounds good to me. Move number 3, I want you to recheck your dividend and income investments. The third move is to take a fresh look at your dividend paying and your income investments. And here's why. When rates drop, traditional safe investments like CDs or treasuries tend to yield less. And that often makes dividend paying stocks look a little bit more attractive. And yes, that may boost demand for certain type of blue chip names that most of us are familiar with. But don't assume it's a guaranteed win. Not all dividend stocks benefit equally. Utilities and REITs, they often get a short-term boost when rates fall. But if rates are cut because the economy is weakening, these same companies, well, they could struggle. Focus on quality. Always a good idea. A strong dividend track record, a healthy balance sheet, and consistent cash flow are way more important, in my opinion, than a high yield. And speaking of high yields, beware of yield traps. If a company is paying 7 or 8% dividend while its peers are paying 3 or 4%, that's usually not a good sign. It's not a gift. So should you chase dividend stocks when the Fed cuts rates? Not blindly. Use the opportunity to recheck the quality of your income investments and make sure they fit into your bigger retirement picture. Move number 4, rebalance your risk. Here's what often happens when the Fed cuts rates. The market gets excited, it rallies, bond rallies, and suddenly your portfolio may look very different than you ever intended. If you set your allocation at say 60-40 and stocks run higher, you might be at 70-30 before you know it. And that means you're taking way more risk than you ever planned for. For retirees, that's dangerous because if the markets reverse, if they go backwards, you don't always have the luxury of waiting it out like younger investors. So what's the smart move here? Use rate cut rallies as an opportunity to rebalance. Trim some of those gains in equities if they're run hot for a bit. Reallocate back into your target mix. It's not about time in the market. That's not what we're talking about. It's controlling your risk so you don't wake up one day with way more stock market exposure than you ever bargained for. Let's move on to move number 5. The fifth smart move is all about taxes. My favorite thing to talk about. Rate cuts often shake up the markets, and that can open doors for tax planning. And here's a few things for you to think about. Roth conversions. Look, if the markets dip around a rate cut or an economic slowdown, converting IRA dollars at a lower values, well, that can be pretty powerful. You pay taxes on a smaller amount, and all the recovery that happens, all that growth that potentially is going to occur is going to happen tax-free. Tax loss harvesting. Look, rate cuts, well, sometimes they come during economic slowdowns. If some positions are down in your portfolio, you may be able to harvest those losses and offset some gains. How about capital gain harvesting? On the flip side, if markets pop on a rate cut, you may be able to harvest some gains in a controlled way, especially if you're in a capital gains bracket, 0 or 15%. It might look really attractive. The key is to look beyond the headlines and look at your portfolio. Rate cuts change valuations, and that can create tax opportunities if you're paying attention. And finally, move number 6. Don't let too much cash sit idle on the sidelines. I call that lazy money. And this one really stings for retirees. When the Fed raises rates, savers cheer because money market yields are higher, CD yields are higher, and they're finally paying something. But when the rates cut, well, those yields can drop fast. And if you're sitting on a pile of cash, then you may suddenly earn next to nothing on it. So what do? Keep your emergency fund intact. I always think that's priority number 1. But for that excess cash, look, you know if you have it, bond ladders, brokered CDs, maybe fixed annuities, a mix of conservative investments that can still give you stability and some return. The goal here is to keep up with inflation. Don't let fear push you into extremes. Keeping some dry powder is smart, but keeping way too much idle cash in a falling rate world can quietly erode your retirement plan. So be very careful here. So let's go ahead and recap those 6 smart moves. Make sure you get your pen and paper out because these are important. So number 1 on the list, revisit your fixed income strategy. Really important. Number 2, consider debt and refinancing opportunities if you have any debt. 3 on the list, recheck dividend and income investments. Number 4, rebalance your portfolio for the risk you are today. I like to tell people to invest their age. Number 5, look for tax planning opportunities. And number 6, don't let too much lazy money sit around. Here's the bigger point. The Federal Reserve cutting rates doesn't automatically mean good or bad news for your retirement. What matters is how you adjust your plan to take advantage of the opportunities and how you avoid the pitfalls. At my firm, Martin Wealth Solutions, this is exactly what we do to help our clients make smart, forward-looking adjustments to their plans so they can stay confident no matter what. If you want to learn more about what we do, go out to martinwealth.com. Now, with that said, if you found this video helpful, do me a quick favor. Make sure you hit like and subscribe. That lets other people know about it. More than anything, thanks for watching. I'm Jim Martin, and we'll be back next week. Take care.